I would like to highlight the principles of successful long-term investing. Long-term investing is somewhat equivalent to the buy and hold strategy. It involves buying a stock with the intention of holding that particular investment for the long run, for a very long time, regardless of the normal market fluctuation. So I'm talking about 10 key principles of long-term investing. Number one, invest in quality companies. Invest in quality companies. Invest in companies that are market leaders, that have competitive advantages, that have a strong financials, strong balance sheet, fortress balance sheet, companies with consistent performance over the years, reliable companies that are very, very strong, that will not be readily moved by the economic conditions that prevails at a particular point in time. And so these companies are reliable, they are strong, they have a history of dividend payments, and they have a kind of defensive characteristics, blue chip characteristics. These are the kind of investment you are expected to buy and hold on to it for a very long time. Number two, diversify your portfolio. The market is always fraught with risk, and that calls for the idea of diversifying your portfolio. When you diversify your portfolio across sectors, across industries, and sometimes, across even geographical boundaries, you kind of, have a level of safety so that should in case a particular industry or a sector performs poorly, it will not affect your overall investment returns on the long run. So you need to diversify your portfolios. Don't just buy a few stocks and keep them within a few industry or sectors. No. Buy as much as necessary and spread your risk across different industries and across different sectors. Number three, focus on the long term. Just like the topic, talks about, we are considering long-term investment. And so your focus should be what? Should be, a long-time horizon. You don't buy with the idea of selling within, a few months or a few years. You buy this particular investment, this particular stock, with the idea of holding them for a very long time, possibly decades. So you can have that benefit of compound interest and, of course, capital appreciation over the years. So make sure that the kind of stocks you are selecting will be the type that will deliver consistent returns over the long run. Number four, reinvest dividends. You create a program of automatically reinvesting whatever dividends accrues to you from your investment. Don't just spend the dividends. Don't use them to take care of your emergency, financial needs. No, as the dividends are being paid, you devise an automated means of, automatically reinvesting those dividends to go a long way in compounding your returns over a long period. Number five, ignore market noise. You are expected or advised to ignore, short-term market noise. Talk about fluctuation in the market, volatility in the markets that have a short-term effect. You disregard all those things. Sometimes your investments, the stocks you bought may go down temporarily, and if the downward trend is not really backed up by any solid financial uh, result, it's not as a result of the company performing poorly financially, you disregard it, because over the long term the stock will rebounce back and then will then appreciate if you don't sell out of panic. And so ignore market noise. Number six, regularly review your portfolio. It's necessary for you to review your portfolio regularly, usually maybe after every 3 months, every 3 months, quarterly. When the results are out, when the results are published, you go through the financials of each company you've bought and ascertain whether the companies are still making profits or not. If they are still making profits, of course, you keep them. Then those that unfortunately incur losses, and if the losses are going to persist for the long run, I will advise you sell them and buy, or increase your holdings, and or buy the ones that are doing that are performing very well. And not only that, number 7, minimize fees and costs. Sometimes, investments will attract fees, will attract, costs, will attract commission. And so for you to minimize this fee that will might end up eating into your return, it's necessary you invest in index funds. Index funds are known to charge very low fees compared to actively managed funds. So when you have index investments, your fees are very low, and then at the end of the day, you discover that your returns are not negatively impacted by the level of fees that the managers are charging. I want to advise that you adhere strictly to all these keys and all these principles, and as you do that, strictly, there's a tendency, there's that particular tendency that you have a positive outcome, over a long period of time. Number 8, be tax efficient. Usually, when it comes to, taxes, these are things we cannot avoid. Even in the market, your investment returns are going to be taxed. But then for you to be tax efficient, you need to hold your investment for the long run, because capital gain tax, are incurred if you sell your investments, within a short period of time. The tax level is going to be very high. But if you hold your investment for the long run, the tax on your compounding, will be very, very low. It's simply a matter of time, a matter of the duration you hold your investment, you hold on to your investments. And not only that, even your dividends are taxed, at a lower rate compared to your other forms of income. I would plead and solicit that you subscribe to this particular channel and give me a thumbs up and press the notification button so that I'll be happy to keep on bringing to you contents of this nature that will help you in your investment journey. Number 9, stay disciplined, in a downturn. Stay disciplined in downturn. Usually, the market will not rise forever. The market fluctuates, and that is a very, very important characteristic of the market. Feature of the market, it fluctuates. So when the market fluctuates and take a downward turn, you don't panic and sell your investment. No, you don't do that. You hold on to your investment as long as the fundamentals are still the same or are improving. As long as the company keep on making profits, don't be moved by short-term volatility or short-term movement in the market, short-term downward trend in the market. Hold on to your investment. These things are expected to occur, but be disciplined, stay disciplined. Don't be moved by them. Hold on to your investment. At the end of the day, you will accumulate, higher returns if you stay disciplined. Number 10, trust in compound interest. Someone said that the compound interest is the seventh wonders of the world. Well, it could be true actually. When it comes to investing, time plays a critical role. If you hold your investment for the long run, I'm telling you, you will surprise the kind of results you are going to obtain compared to just selling within few years. You sell your investment. No, if you hold an investment for 10 years, 15 years, 20 years, the kind of compounding you are going to get at the end of the day. Imagine compounding at an interest of, let's say, maybe at the rate of probably 5% or 7% or 8% a year. Compound for the next, let's say 10, 15 years. The result will baffle you. The result will cause you to marvel. So please, as I told us earlier, invest for the long term, invest for the long run, and the result would be such that would make you financially free at the end of your holding. Don't be moved by the market fluctuation. Keep on holding your investment, and in the long run, you obtain something tangible, something palatable, and something encouraging.